What's going on, guys? Welcome to Collecting Keys Real Estate Podcast. I'm Mike DeHaan here with my co-host Dan Austin and Dylan Cook.
Hey, Dylan, thanks for showing up today.
You can't blame that on me. This was your fault last week.
We rescheduled, so Mike doesn't even know about this. Mike, you probably know who I recorded with last week.
Did you record with Aaron?
Yeah, so last week, my internet went out like 19 minutes into the recording. It was the best show. Dylan and I were just fucking...
We were about, 15 minutes in, I think?
It was such good topics. You guys will never hear it. And then my internet just went out. So anyways, Friday, Dylan and I we're going to reschedule. Dylan bailed on me. Couldn't do it because he scheduled the time.
I said the time.
And then didn't show up.
Nice.
But to be fair, I said 3 p.m. Eastern the next day. Like we did this the day before. And it's like 1:30, like an hour and a half before the recording. Dan's like, oh yeah, I can do it then. And like I was already gone. Like
I didn't see your message. But anyways, so I text Aaron and Greg Hellback in a group chat and I was like, hey, can either you guys record right now? I was like, I got a spot. And in typical like real estate investor fashion, they're both kind of like midday available, but not available. Like Greg was playing hockey. And then, and then Aaron was just getting back into his house and he was like, right now? And I was like, yeah. He's like, give me a minute. And of course, Aaron's a G. So he just signs on and we just talked about his getting 86 from Pace's Facebook or Instagram and all that. So it was a good episode.
Nice.
I thought it was.
That's funny. I didn't know that. I when we logged on here, I saw the thumbnail and I was like, is that an old thumbnail from like a couple of weeks ago?
Yeah. It was a whole debacle. Mike leaves town. We can't figure shit out.
I know. Max, our producer, messaged me and he's like, these boys really can't do shit if you're not around. He's like, it's such a disaster.
I tried, dude. It was just the scheduling and
2026 internet problems.
Yeah, seriously.
At the end of the day, all that matters is we are almost 500 episodes deep and we still have not missed a week, Dan.
Yeah, and I know. I told Dylan, I was like, hey, I'll take the heat for this dog, but you fucking getting a mark on your record.
Oh, yeah, man. We're committed, dude. I remember one time when we used to do three a week, we would do like the Friday Focuses, and it was my turn to do it, and I was like, fuck. And I was in Africa, and I'm literally sitting at this like tiny-ass airport in Namibia, which is this little country that's north of South Africa on the Atlantic Ocean. And I'm out like in the middle of the desert at this tiny little airport and we're going to do like this scenic flight over the sand dunes. And I'm like, I got to record this right now. Like otherwise our producer's going to get together. And so I went and I like sat in the corner of like this little airport and I recorded a freaking podcast for like 9 minutes.
Dedication.
Audio was trash. Sent it over to Max. But hey, it went live. Good to go. Easy enough.
Yeah. We were a full-time podcaster.
Is there any celebration or special occasion planned for the 500th?
Yeah. Oh, we should be. We're coming up. We should do something. We're like 5 away.
Yeah. We're going to do like an in-person podcast and it's going to be this big epic party. We're going to have some drinks and people are going to be able to show up and have a good time and listen to us talk.
I can't wait for like all 7 of us to have a great time.
We're opening up to all the listeners that want to show up.
That would actually be really funny. We should announce it like, we're going to do it at the Barnes & Noble in Spokane Valley.
Dude, you know what's crazy is we got some OGs show up randomly.
Oh, we probably would too. Yeah. Hey, we get new listeners all the time. I got a guy reach out to me today that was like, hey, I just started listening to your show. I was like, I love it. He's like, I bounce back between the old stuff and the new stuff because like he's kind of where we were years and years ago. He's like, but I also want to know what you guys are doing now. I'm like, there we go. That's great.
Yeah, see, he wants to see the future and the past. That's great. Mm-hmm. Exactly. Awesome. Welcome, new listener 182.
Yeah, right. I mean, we've had some of especially after the whole Brandon Turner thing, we actually got a lot of new listeners from that.
Yeah, we're famous actually now.
I don't know how long they're going to stick around because I'm pretty sure the very next episode was the one where Dan opened with a retard maxing. So we lost all of the people that were sensitive to that right off the bat.
Yeah, we definitely netted a few, but yeah, I mean, I'm not the one out here making it up. It's topical news. Everybody needs to know what's out there on the internet.
And it's already old news now because that's the way the internet works.
Mm-hmm.
But anyways, in topical news, what we were talking about at the very start there, Dan hopped onto the show and said the first thing to me and Dylan, when this is actually only posted about 3 hours ago. So this is very brave.
I watch the news closely for everybody here.
Yeah, I know you have like a big screen that just plays Fox News all the time.
It's a ticker. It's a Fox News ticker. Yeah, Fox News is definitely not reporting on Trump. They're reporting on Kiavi instead.
Exactly. But Kiavi has signed an agreement to be acquired by Figure Technology. So Figure's another lending company. If you guys have like loan officers or brokers in your social media, you probably see them advertise these like 3-day HELOCs, which I've always found to be kind of bullshit because they like have all these really weird requirements and it needs to be like in your personal name, but it also needs to be an investment property. It's weird. But I guess they're acquiring Kiavi for $717 million, which is interesting because I feel like that my initial gut reaction with that was low. But in the article we found, it kind of goes into revenue and their EBITDA, and that is about 7x, which is kind of industry standard, 7 to 9x. And with these kind of companies, if they're bigger, the equity multiple will typically be a little bit smaller. And I would also imagine that that is only for probably Kiavi's pipeline and brand and everything else, because I know for a fact that a lot of the securitizations that they've done with their debt is like larger than that number.
Yeah, they got to be holding at least $1 billion on the actual debt side.
At least. So yeah, like how that all is structured, I have no idea, but it'll be interesting to sort of see this come together. And I think that that'll be a very, very big change to the lending space because Kiavi, I guess the private lending space, because Kiavi is by far the biggest real estate investment lender out there, like not even close to anybody else.
Yeah, they're massive.
Like, is this going to set any kind of precedent, or is this kind of, you think, par for the course based on what's been presented so far?
So, like, I mean, I literally heard about this 10 minutes ago, so I don't know. But I will say that around COVID and, like even like right before that, there was a handful of other big lenders that got acquired for pretty hefty multiples. Okay. So I think that's kind of the play. Because like Kiavi as like a brand hasn't been around that long. They were like lending home like 7 or 8 years ago when they first started.
Dude, yeah. Maybe like 6 years ago.
Yeah. There's like a lot of other lending companies that got acquired relatively quickly after they were founded. So I almost feel like the play is if you can get something to critical mass and then you exit to like the bigger money.
Yeah, I think that kind of, you got to remember too, the private lending space is not that old. Like, yes, it's old. It's been around forever, you could say, but like in what we know in modern history, maybe 15, 20 years old, really, and less so to what it is today. Like I would even give it I would say 10 years. Like to how it looks today from what it was the 10 years prior to that. Because it's, of course, been around longer, but it's pretty modern and how we do things and the scale at which Kiavi was able to do it.
It's probably kind of analogous to wholesaling where a lot of competition came in. It drove up the, the standard of which everything was done. And then of course, prices rose over the past 20 years. So that just increases the volume naturally.
But you think all the vendors that came to wholesaling, like you just have all the new CRMs, you have all the mail companies, all the that made it so easy. The same thing is happening with private lending.
And the tech to do it too. Yeah.
Tech is coming in. And Kiavi at its roots was a tech company, which kind of uprooted and changed things. So it is kind of surprising that they're not doing acquisitions and instead are the ones getting acquired. But I do think for the founders and the owners of these companies like that, that really kind of is the play, is like a lender, or I'll even say originator, because you don't even have to be lending money like your own money, but as an originator building up a massive pipeline or a big pipeline, you can sell that infrastructure in that pipeline. It's not necessarily the pipeline of repeat clients. In my opinion, it's the pipeline of being able to find these clients and having a product and marketing that fits the needs of that marketplace. Because you got to remember, this is a pretty fractionalized industry still, even though you have national lenders and you have private lenders in every market by the dozen. Do you know what I mean? It's pretty fractionalized. So being able to bring that in and grow through acquisition, because one thing Mike and I were talking about last night was, my opinion is like, there's so much demand for growth, especially in the top 3-4 companies and more in this industry, that they'll do almost anything to get more throughput through their pipeline, more loans, more originations through their pipeline. Because a lot of them have securitizations where you can think of it as this: you get $100 million balance sheet of loans, right? So you bring in $100 million, you loan it out. So your balance sheet has $100 million in assets. You go and sell that. You've done that debt at say 10, 11%. Now you go and raise at 4.5% to 5% in essentially a bond or securitization. And they give you that money to basically buy, you're pledging those notes. And then you got to keep that going. Every time $10 million rolls off, you better go and roll that back on and to top off your securitization, because otherwise they're going to be on your ass. Also, they have large bank warehouse lines that have non-utilization rates where you might have to pay 1 or 2% of the overall. Say you got $100 million in warehouse lines, that's going to start costing you months. So these big players that have that, they're really incentivized to originate regardless of the quality of the debt they're originating.
Because they got to pay those fees based on that, right?
Yeah, they're incentivized to keep originating.
Yeah. And like on the private side too, the buyer pool is a lot more diverse than the conventional side. Cause like there's a huge number of companies, banks, family offices, insurance companies that will buy this kind of debt. And so to Dan's point, they're incentivized to generate as much as possible. If something isn't sellable to one person or one securitization, you can always roll into other ones. Right. And so like I just have this Housing Wire article pulled up about Figure, basically talking about, I don't know who they're talking to. Figure is the Figure CEO. So I didn't realize Figure, almost their entire business has been second position liens, which is crazy.
That is crazy.
Their goal with buying Kiavi is to majorly increase their first position. And basically what they're going to be doing is they're a blockchain based company, whatever that really means. I don't know. I'm not that smart. But basically they're using their technology to be able to offer RTL and DSCR loans to their 380 partners. So they have 380 different companies that they can originate and sell loans to, which is crazy. Think about how much of a pain in the ass it is for us, Dan, and we have like 5. I can't imagine 380. That's very
100 people in their capital market side of the business is probably going to be crazy.
At least, if not more. So
what do you think the minimum in EBITDA is get acquired? Because like, what if I just went and got an EBITDA is like 500K and the guy got acquired for $4 million? Like that sounds kind of cool.
No, because that's going to be too small, right? Like someone might pay you like $1 million for that.
Only because you also don't have the infrastructure in place for
right. I understand that part.
Yeah. But there's kind of a minimum side to be able to get like a real multiple on it. I don't know what that amount would be, but I mean, we know a guy that sold his company to Longhorn Investments. I don't know what he actually did for. Merged. Yeah.
Merged was fun
so
with them.
I think that'd be more common if you were smaller, right? Is you wouldn't necessarily get like a buyout, but you could like jump in with them and get some kind of incentive.
I had one buyer use Longhorn once and it was an awful process. I was saying,
really?
Yeah. For they're very expensive too, just 12-3 across the board.
Yeah.
Which is crazy.
Yeah. We had
they're
like 5 times.
They're an interesting model because like by all accounts, like they're a balance sheet lender, right? Like that's why they won't lend in certain states. There's certain states that they just won't lend in because of foreclosure issues, right?
Yeah.
But yeah, they're probably 200, they were 200 million before they merged with the guy Mike was talking about. So they're probably close to 300 million now, which is a decent size balance sheet lender for some, like it's just a couple guys kind of like Mike and I that started it. But we've talked to another couple friends of ours that own a company down in Phoenix. What is their fund, like 100?
150, I think they said. Yeah.
And they're the same thing. They lend in a few states and they're 12-3 across the board. Like, we like the dirty, we don't even pull credit. Like we want it to be a good asset. They're really asset heavy on their underwriting. And they want the guy to have a track record or the person to have a track record. And they're just 12-3 and they freaking kill it.
And they do lower LTV. Right. Mm-hmm. Especially they're based out of Arizona and they do a lot of stuff in Arizona and Texas. So they'll do a lot of like foreign nationals or, non-Social Security number sort of people.
Which is why, like, for me, there's not really a lot of scarcity because you have on the flip side people doing 100% lending, right? So you think you've got to compete with that, like 100% LTC. Oh, I got to be down around 10%, 1 point. Yeah, sure. That there's a market for that, but there's also a market for 12-3 at 80% LTV or LTC.
Absolutely. Yeah.
See, that's wild to me. Because I know, like, the people around me that I know, if you told them that they had to go 12-3 at 80% LTC, they'd be like, no. Like, they wouldn't even consider it.
Yeah.
I know.
Like,
I bet you there's some folks in Cincy and, around that area that would do that eventually.
Right.
You don't know them. Yeah.
I just don't know them. You're right.
Yeah.
That's
the
my
higher quality
bias.
the higher quality borrowers have options, right? And by lower quality on these guys doing the 12-3, that's not necessarily lower quality. They just can't go to the high quality because the lower quality, that's all balance sheet lenders, right? The 2 people we just talked about, Longhorn and this other company, they have a fund, so they get to pick and choose, which is actually a really, really profitable strategy. When you're selling the debt, you're basically having to have a conforming loan at this point, right? They want the borrowers to have a 700 plus credit score. They want this, they want that. So it's just a totally different business model for a totally different borrower.
Yeah. And I will say there's a lot of lower quality borrowers that should go to those 12-3 guys, but they don't because they're entitled and they think they want 100% with like
totally.
You have like 6. We just actually reviewed a borrower. This isn't This is a different one, but it had like 6 acts of public lewd conduct or something like that.
Nice. Whatever that means.
Whatever that means. Or another credit report, the background report. You get some of these people that are like, yeah, sorry, in 2023, it was so long ago, I beat my wife and got arrested. Like, okay. Shit like that. Like you see some of the, those are the borrowers that are trying to get the 10-1, and you're like, dude, you don't get 10-1 when you're like beating people and getting DUIs.
Yeah. Or it's tough too, because what'll happen is you'll have some of these people that are like new, or they do have bad credit, and they happen to meet a local hard money lender, whether that's like a rich guy or that's like a couple of rich guys that just have some money, and they will do like super low due diligence loans. They'll be like, oh yeah, we'll do 11 and 2. You're completely green. We'll give you 100% perks, 100% reno. We don't care. And they're kind of careless. The lender is also part of their business plan is they're like, hey, I'll happily take that property back from you if you screw it up. And they're happy to do that, which like most lending companies aren't that way. And the challenge is you'll get people that work with lenders like that, and then they come to shop around, go somewhere else because that lender runs out of money. They don't want to pay that much, whatever. But now they're kind of tainted, right? Like their mentality around what to expect from a lending company doesn't make sense because they had this first interaction with a company that's not the norm. It's like the lending equivalent of a wholesaler who goes and like locks up a contract for way too high and then can't close. But now that seller is like clinging on to $300,000, and every other person they talk to, they're like, well, Jimmy offered me $300,000 3 months ago. I'm like, yeah, but Jimmy didn't buy your fucking property, Greg. Yeah, like, I don't know what to tell you.
That's a good analogy.
So we see the exact same thing all the time. And like we have one of these companies here in town. They recently ran out of money, and all of their borrowers are coming to us, and their borrowers are like the most unqualified people. Yeah, like no money, no credit, no experience. But they all came out of like a...
They think they're cool, so they're assholes.
Yeah, because they all came out of like a flipping mastermind. So they're like, I know a lot about everything, even though they've like never done a house before. You know, we had one guy reach out. He has 6 loans with this other company. And I know this guy's committed fraud because he reached out to us in the past. And I looked him up, and he has charges against him for, I think it was like not paying his employees. And it was like a whole thing. So he's already stolen money from people, as far as I'm concerned. He reached out. He's like, hey, I have 6 loans with this other company. I'd love to bring some of these to you guys. We know they're out of money and you're desperate. And then the first question he asked, he goes, do you guys ever refinance existing fix and flip loans? So you're not cooked. You means you're screwed then, dude. I know you're about to default on a bunch of those, and you're looking for the next person to kick the can. Like, get out of here.
Yeah, you don't want to deal with those.
Reminds me of not someone similar, but we're trying to rent a unit right now, and I got an application the other day, and the credit score is 486, I think.
That's pretty good.
Yeah. And then like on the application, it says something along the lines of COVID ruined my credit. Like, I was like, that was 6 years ago.
That was a long time ago.
I was just like, decline.
So you've had a long time to figure that out. But yeah, so I'll be interested to see if like the Kiavi name still sticks around, if they keep it, or if all of a sudden we're getting all these term sheets to compete with from Figure. That'll be interesting. So either way, these kind of purchases, I mean, it was just announced today, so I would imagine they're a little ways along, but it could always fall out or change or whatever.
Kiavi should have went public. They would have made more money.
Yeah, they could have. So I guess Figure is publicly traded, which is interesting.
Are they?
I didn't know that.
Oh, okay. I didn't know that either.
Yeah.
But speaking of public companies, you guys going to buy the SpaceX IPO that's going to happen on Friday?
Well, I can't buy it like now. I don't want to buy it afterwards.
No. Exactly. You don't want to buy it when it's open to the masses.
So a friend of the show, I won't say his name because he's a humble man, might stand to make a shit ton of money on this IPO because he was invested in it.
Oh, I know who you're talking about. Yeah, I mean, that's good for him. But how did he get access to that?
Who knows?
Because he's awesome. I don't know. Like, it's just better than us at life.
Yeah.
I was reading some stuff on it. It's supposed to go live on Friday and at like $135 a share. But like that, with how many shares there are, it's like a $1.77 trillion valuation.
It's crazy.
Which breaks the IPO record for like the starting valuation on an IPO day. And it's all for a company that has like 18.7 billion in revenue and an operating loss of 4.2 billion. I mean, any metric that I follow from like price earnings, price to book, like all these things that I've been learned to look at make 0 sense with this.
Yeah.
Who decides like the valuation? And like,
I guess there's the Elon effect here, right? And I think that there's a lot of people a lot of people that are hyping it, and then there's a lot of people that are unhyping it, right? So there's like, I feel like the truth is hard to find. Like, what is the fact? What actually matters?
Like, I don't know where like the dollar per share and the like all that stuff comes from.
Bankers come up with all that, right? Like,
they probably pay investment bank stuff. Which I read is like earning $400 million just on this IPO for doing the IPO.
Yeah, but like, what is it based on? They come up with it, but like, why don't they just price it at what they want to do and sell it to all the schmucks?
Like, Dylan's like, well, historically, whatever. Here's kind of, I guess, my opinion on it. I'm not going to buy the IPO because the way I invest is usually I buy high and sell low. So I just, especially when I don't understand it, to your point, Dylan, like, you know more about this stuff than I do. And you're like, this doesn't make any sense. When there's all the media hype around something like this, like that gives you conflicting points of views based on personal biases or personal benefit. But I'll give you what I kind of think about it is that the big difference here is that the NASDAQ is going to, how many days after the IPO is going to allow retail traders?
I think it's only 30.
It's used to be like 8 months or whatever. So here's what's going to happen is it's going to IPO. There's a ton of hype around it. There's a lot of Elon followers that just want to invest in Elon. People have been wanting to buy into SpaceX for years. I think long term, there's probably a huge upside, right? Like, they are so far and above the rest of the world in space. And he's basically building an alternative internet, or has already built it, which is wild, right? Like, you think about stuff like that, it's pretty crazy. And then with like XAI, when he was spending all that money to build out the servers or whatever you call them, the AI freaking buildings, and people are like, wow, he's investing a shit ton of money. And then people were giving him shit about that. And then he went and turned around and did like was it a $20 billion contract with Anthropic that then made Anthropic the most valuable AI company? Like, just that like simple stuff alone, I think long term makes a lot of sense. Here's why I don't think it'll just completely wipe out and crash right away is because I think a couple pods ago, we talked about how like 401k money is like 30-something% of all retail trading. Like, that is going to come in and swoop and be forced to buy it. And I think that will prop up the actual price so that retail people that want to come in and buy in a normal IPO, say you're saying $135 a share and the valuation doesn't make any sense and all the hype goes away. And then all of a sudden the private guys get cashed out and they're freaking rich now. All the employees are rich and they want to start dumping shares. You know what I mean?
Yeah. There's supposed to be 4,000 millionaires just like that are employees.
Right. And guess what? This is my theory anyways, where there would typically be a gap in buyers. 401k money is going to come up and grab that because they have to, because they're buying indexes.
So I just saw this like the other day that they changed the rules, or like they're not allowing SpaceX to be put on one of those indexes. So the 401ks won't be buying it up like they originally thought.
They're not going to, but so trade on the NASDAQs, but they're not allowed
That's like a very recent change then.
This is like in the last day. I saw it yesterday, I think.
Well, they weren't going to expedite it. It'll be there eventually, but they weren't going to expedite it.
Is that what it was?
Yeah, okay. Right.
Okay, so they're going back to their normal rules, which was you had to wait 8 months.
I don't know the timeline, but that sounds
like
about
12
right.
months.
12 months, okay. Okay, so my theory kind of goes away then. If 401k money doesn't get forced to go and buy it. Because a lot of people were like, oh man, this is the pundit, like, oh, they're going to wipe out everybody's retirements. Everybody's going to be poor again. I'm like, yeah, but people in their retirements don't really touch their 401ks for a long time. And so if you're long on it, which I would be long on SpaceX because there is a lot of value there, then why wouldn't it just help them? Right. But
I'm taking the under. Here's my hot take that internet can cook me on in 5 years. I bet it is under 135 a share 5 years from the IPO.
Possibly. Yeah, 5 years is short term though.
Well, you got to account for inflation with that, Dylan. Because how much is the dollar today going to be worth in 5 years?
Yeah,
it's very fair. You're wrong.
Let's do this. What's Bitcoin going to be in 5 years, Dylan? Better. Hopefully it's more than fucking 58 or whatever it is.
I'll say over 250.
Over 250? That's it?
250K. Yeah.
Do you think that the recent dip in Bitcoin is for people who are stupid investors that just buy the hype, are selling their Bitcoin and going to getting liquid for SpaceX?
There was speculation.
Because it seems like most Bitcoin investors they buy hype.
Yeah. And there was a pretty good chart out how Bitcoin's price has followed a lot of the software companies, like a software index pretty much. So to answer your question, like maybe, but at the same time, like, to me, there's not the same trade, but I think that's my own like mind and not maybe the general public's mind.
Yeah, good point. Yeah, I think there's a lot of bros out there that are like, oh, SpaceX, we got to buy it, man. This is the next big lift. And they don't actually, listen to the other side of the argument of where maybe it won't be like a huge ups, because the people that are winning are the guys cashing out.
Yeah. My default position, if I know that everyone else is doing it, it's probably not going to work in the near, very shortly after that.
Right. Totally. Yeah. Well, I think there's definitely a lot to be said about that.
There's always that old saying, buy the hype, sell the news. Mm-hmm. Like that's super true when it comes to all this kind of stuff, especially these days where it's so easy to manipulate things. You just got to like not get your, I don't know, like too emotionally tied to stuff, right? And you have to understand that you are buying the hype. And I think if you take that hype and you make that fact for yourself, is where you're going to get burned these days.
Well, there are plenty of people that probably have the opinion like, oh, I'll go public at 135. I'm going to try as much as I can, and I'm going to buy the open and sell the close, like hoping that it just goes up on the same day, right? Mm-hmm. And make a quick, call it a couple thousand, $10,000. But that could easily go the other way. So
totally, dude.
I don't know.
It's called gambling, Dylan.
Yeah, might as well just go play blackjack at the casino.
Yeah, people like to gamble. It's never been easier, especially like Robinhood and all these like free trades where they can like do it instantly and they don't charge you anything. Really, what you should be doing is, if you want to like make much better odds, you should be going on like Polymarket and like place a bet for like where it's going to finish at the end of day one. Because there's probably like some huge spreads you can get on that, like 9x that it's above like 150 or something.
Mike, what's your Polymarket account? What's your plus minus?
On what it's going to finish at?
No, like just in general. Because don't you do a bunch of Polymarket stuff? Or
no, dude. No, I know. I did that like one time with $250.
Okay.
I think it's all gone. I was up for a little while, but then I started betting on like dumb stuff. And I don't care. Like the problem is in order to like really get into that, you either have to be a real degenerate gambler or you have to care about stuff. Yeah. Like what's actually going on. And I really don't. I'm not going to sit there and like see what fucking Kristi Noem says on a speech to like see what she's going to say. Like people think that's fun. I got other stuff to do. I just forget.
Other people who bet like on ping pong at 3 a.m. on what the next point's going to like. It's some obscure, insane stuff.
If I wasn't doing anything at that point in time, sure, I would do it. I'd have fun, but it's an in the moment thing. Like I don't like to pursue random things like that because I don't have the time. I have way better interests. But if I'm sitting there bored and I have nothing else to do, and you want to gamble on some shit, let's do it.
Like if I'm going to gamble, it's something that's like right in front of me. Right. That I can like perceive. I don't like care about like just like numbers on a screen where like, oh man, is the Japanese ping ponger or the American ping ponger going to win? Like, I don't care.
Oh, you want it in person.
Yeah.
Like you want someone to like a wrestling challenge, someone to a wrestling match and gamble on it.
Or even something like dumb. Like there's this Instagram account that I follow and they'll just like bet on like stupid stuff. They'll be like sitting on like a hotel balcony and there will be like some people like shooting hoops like down at the beach and they'll be like, all right, I'll bet you $5 that this guy misses 3 shots in a row. Like that's entertaining to me because it's funny.
That's fun.
So I can agree. It's not real money.
More related news. It came out yesterday, maybe this morning. The CPI, which is a consumer price index, but inflation for lack of a better term, increased 4.2% year over year, which was much higher than expectations.
Is it really higher than expectations or is it higher than they're telling us the expectations should be?
Well, probably that. But, that's what the news media came out. But I mean, couple tidbits out of this was like their core CPI number, which is, I guess, what a lot of the economists use to actually gauge where interest rates should go, came in at 2.9% year over year. But that excludes food and energy costs. Which okay, that's dumb in my opinion, because obviously those are 2 staple things that people need in their life.
Correct.
And that a report indicated that much of the inflation surge came from a 3.9% jump in energy prices, which the 12-month increase was 23.5% in energy, which a lot of that I think is like the strait being closed still. So I don't know if there will be a transitory effect with that or not, but
it's interesting that energy costs. You're saying the energy costs in the U.S. jumped that much, 23%
year over year.
And is that just related to gas and oil? I guess because
and like your gas and like your electric and gas bills, that kind of stuff too.
But like your electric and gas bill shouldn't change.
What's going to happen to energy with all these data centers? So this is a big thing up here right now. Our utility, we have like the one main utility here locally. They got an application from a new customer that is basically going to be 30% of their potential power generation when it reaches full capacity.
16.
Is it 60%? 16% when it starts. When it starts. And then they're saying by 2030 something, it should be at 30%. It's like 500 megawatts or whatever. That's their energy generation capacity. I don't know what it is of like their daily generation or what percentages, but it's in a massive amount. It's going to be like the equivalent of like half the city is going to be going to this one customer.
So I mean, I think it's definitely a problem because you got to think no major city is designed for the fact to use that much energy.
No.
Right. So you have to redo a lot of the infrastructure.
I think it's a big fat nothing sandwich. Aaron and I actually talked about this a little bit last week. Yeah, because, okay, so which is easy to do. Here's a good example. Washington State's actually a really good example of this because we have a pretty liberal utilities commission and we're regulated, which as are most states. There's only a handful of states like Texas that aren't regulated. But especially when you have a pretty liberal utilities commission, they are very much so for the people. They're like, to the point to where they'll raise the rates on average people to give poor people free power, right? So they're not going to let people that can't afford their bill to be adversely affected, is what I'm saying. That'll be across the board in most states because there's enough media on it. But think about this. It's, in my opinion, better for the electric grid because you're going to have this data center that comes in and say they need 500 megawatts of usage. They're going to come in and they're going to be forced to build out all of the infrastructure, right? So say they build this thing, they're not going to build it right in a city because they can't. The real estate values don't make sense. And honestly, wherever they're putting it in Spokane, it's actually not going to be in Spokane. It's going to be somewhere out near like Othello, which is also in our utilities area. So it doesn't really affect anybody in our town. So the way these public announcements are somewhat deceiving. But my point being is they're going to build out all the infrastructure outside of town, which means now if you want to develop property all the way between town and that data center, you now have paid for infrastructure, which would normally cost like $1 million a mile to just build out, right? So if you're 10 miles out of town and you wanted to build a house 10 miles out of town, now you have $10 million of infrastructure built out so you don't have to pay for it, paid for by the data center. On top of that, they're going to bring their own generation. So if they bring their own generation, what does that do? There's no way they're going to be peaking their generation all the time. So now they'll have the ability to sell back into the system. And now you have additional resiliency and additional generation capacity that did not exist near the load.
So the data center is going to bring their own generation. Like how are they?
Generally speaking, they will have their own generation, and they want to. They need to, because it's like they need to have massive uptime. So say if you're going to add 500 megawatts, right? You know this, Mike, because you're an electrical engineer. You have to have the exact amount of generation at the exact second that you're using it. So your power system has to be completely balanced. So for them just to add 500 megawatts, you can't do that without a generator.
Yeah.
And so if the data center has to have generation to support it, they're going to have to pay and build it. And oftentimes they're going to be bringing generation like where we're at, probably like solar will be a lot of it with a bunch of battery backup and probably like natural gas peakers, which are like an ideal generation source for like resiliency. So to me, I think it's a big fat nothing sandwich.
Interesting.
There's still a lot of political backlash, especially when they buy up like the rural areas for, the prices per acre are astronomical higher to what they used to be.
Yeah. My thought about that is like you redneck hillbillies weren't using that shit for anything anyways.
Yeah.
I'm not like pro AI data center. I just think the power grid, and then they've already debunked the water issue. Like they're like, they took all the water, right?
Next, yeah.
So they've debunked that. And I'm just coming here from the energy standpoint to debunk it because like it just doesn't make any sense that you would have a data center come in and they'd allow you to just suck the lifeblood out of the city using all of their electricity. It's just not possible, especially in most regulated states. But to me, there's a whole nother argument if you want those in your town or in your city or near it. It's just the arguments being played out in the public right now are not the ones you should be arguing because those get debunked right away. Because the data centers, like Elon Musk will be like, cool, I don't want to be hooked to your grid anyways. You guys suck.
Yeah, right.
And just build his own generation and whatever. And then it won't be connected to the grid. Therefore, you won't be getting the additional benefits of somebody who's bringing 500 megawatts of generation, which is hard to build.
Interesting. So what's the water debunk? I haven't heard this.
Basically, that's kind of the same thing to energy is that water will it'll use the surrounding area's natural water supply.
I understand that, but they're saying that's not the case. They're just gonna bring.
Well, yeah, I think the thing about it is, and I haven't gone down the total rabbit hole on this, is that they use water. The theory is that they suck out of the water out of like say you're on an aquifer or a river to cool those data centers, but that's I guess not true. They actually don't consume very much water.
Or I think something about they recycle a lot of the water that they do use.
It's like a cooling,
We should just hook them up to like a wastewater treatment plant. So like
So when it gets a leak, it just gets poop all over their stuff.
Oh, so that was sewage water.
Yeah.
So like my first job was in wastewater treatment, and there's like huge amounts of water that sit between like after the poopy water, but before it's fully cleaned. That is probably usable. Like some that like an animal could drink, but like if a human drank it, it might get kind of ill. Throw them in there.
Like your sewer water. Like I don't know if you ever looked down a sewer pipe. You only see like a turd like every few minutes. There's not that much. A lot of the water is wasted on, showers, washing your hands, pee.
How much time have you spent sitting there looking down the sewer?
I used to work when I was like 18. I had a road construction job where we'd have to like connect sewer lines. So I've seen it before, and I was
they're just looking for turds.
Yeah,
you could make Polymarket bets on how many turds per 10 minutes you're going to see.
If Polymarket was around back then, I certainly would have.
Yeah, there we go.
To round out or cap it off, my whole belief on the data center stuff is it's happening. So you might as well make it to where it benefits you locally and don't miss it. Because another thing that was huge for like the local economy here that is all the data centers we do have in the central Washington area. It's like deserty area. Like that's actually been really good. It's not like a long-term jobs thing, but it was really good because it expanded all of like the electric utilities out to these areas and put in really, really big infrastructure paid for by Microsoft and Amazon. And so it actually ended up being a net positive, and it still does bring jobs because you still always need maintenance people and that sort of stuff. You don't need the 5,000 jobs that they quote in the beginning forever, but you might need that for 5 years and then you still net some jobs.
Well, the devil's advocate argument to that is that the AI that it helps create will get rid of more jobs than it adds. But I'm not saying that's true or false. I'm just saying that's the other side of it.
To me, that's a doomer argument. It's happening no matter what. So it's like, get on, dude. We're going streaking. Let's go.
Yeah. Well, I mean, and then tying this back to the inflation thing that we just talked about is, so Kevin Warsh, the new Fed chair, his first meeting is on, I think the 15th or 16th or 17th. And with this inflation, everyone's like, you can't lower rates, which is what Trump wants him to do.
Yeah.
Right. And so it's kind of the higher for longer narrative when it comes to interest rates still is what the market is betting.
I remember, I think it was like last year, you quote Dylan, you said, this is a decade of inflation. And I believe that, honestly. Yeah. I don't see inflation breaking until and I'm not saying at 2030, before 2030, I should say. I don't see the inflation changing in a meaningful way that people see an impact in their day-to-day lives before 2030. It just doesn't make any sense. We've printed too much money between 2008 and 2020. There's just too much money.
And 2022, like post-COVID, a lot of it too. Like
we kept printing. So it just doesn't make any sense that it would just go away.
Yeah. And that's an investable time horizon. When people say, I invest for 30, like you don't know what 30 years is going to be like. 5 years or less is an investable time horizon where you can make some calculated decisions. Mm-hmm. And then like the whole inflation metrics piss me off anyway, which I know most people probably know this, but like, because it's a year over year, like rate of change number, it's like saying you weighed 100 pounds. The next year you're 105 pounds. So the inflation number, quote unquote, was 5%. But the following year, you're 105 pounds again. They report that as 0, even though you're still 5 pounds heavier.
Yeah.
Right. So exactly, it's just kind of annoying. Like if you do that year over year over year, like the total number is probably 20+%, right? Like,
right. So there's some commentary I was listening from Jay Scott about really what's going on with like the Strait of Hormuz and Iran, and his kind of thought about things breaking here in like a month or two and really causing more of a global recession. And he was kind of talking about it a little bit about inflation. It's interesting commentary, whether you believe what he's saying or not. It's easy to believe in what he's saying because he has a pretty articulated point of view. The thing that I go back to kind of on where we're at in the world is in America, it's pretty awesome right now compared to everybody else in the world. Like people talk about like K-shaped economy and all this sort of stuff. It sucks way worse everywhere else. And the Strait of Hormuz is not really affecting us as adversely as it is the rest of the world. So like they're under pressure. Like I think Jay Scott even said like Vietnam is on a 4-day manufacturing week right now because they don't have enough goods to manufacture. Mm-hmm. Right. That's Vietnam. That's crazy. Right.
Cairo and Egypt, they have a lot of their nightlife, I guess, is in the evening at night. Like that's like the cultural thing there. And they have
because it's hot as fuck.
Yeah.
Right.
But they have like blackouts right now. Like we're cutting off the electric from this time of night because they don't have
I think that's normal, but like it's probably more intense. Yeah,
I think it's more intense than normal. Like I think it made
I would say during the nighttime, they probably wouldn't have it as often. So we used to have a team of Egyptians working for us. They had every part of the city had a 4-hour rolling blackout every day.
Yeah. It's called load shedding. It's pretty common in like third world countries. When I went to South Africa, it was the same thing. And Cape Town's wild. It's like Seattle. It's a modern, like huge city. And then for like 4 hours randomly every day, the power would just go out.
It's wild.
So we'd be like sitting like in our freaking hotel room and like the power would just go out, and the hotels have generators. So like 5 minutes later it would kick back on, but then like the entire city would be dark. It was nuts.
Which to your point, Dylan, at nighttime it's not as common because they don't have as big of a load at night.
Right.
So why they're doing load shedding maybe in extended periods. But yeah, I guess the point I was bringing up is it's like it's more affected, the rest of the world. And so, potentially this global recession, then it maybe bleeds more into the US, right? As far as what happens. But even then, I think like we're better off. It just still sucks.
Yeah. Well, here, I want to say this and we can get off the subject. This is the U.S. Bureau of Labor Statistics, their own CPI inflation calculator. If you go type in $100,000 in January of 2020 up until May of 2026. So what is the equivalent of $100,000 in January of 2020? Any guesses?
136,000 would be today's dollars.
So that's like 6 years.
6 years, yeah.
I'm gonna say 145.
Okay, overshot a little bit. It's 129.9, so 130.
136 sounds close, dog.
But still, I mean, that's 6 years. If you're not getting a $5,000 annual increase in your wages, you are net negative over those 6 years, which I don't think many people have got.
That's hard to get because do the companies have that money to give? That'd be the other question.
That's the other thing.
I mean, they probably do, but like small business probably doesn't.
Are they going to do that? I mean, like really small business, like the low profit margin businesses, definitely not, right? Like honestly.
Right. Walmart probably can't do it. Roll back those prices.
You expect the Walmart family to give up some of their...
Well, so the family now that's different, but the business itself. I mean, I think Walmart actually. What are their margins doing? You probably know this.
Isn't something stupid low, like 4%? Like
I think it's 4%. 4% was the number I wanted to say that I was quoted. So they've been rolling back those prices.
4.1 to 4.3% operating margin, net profit margin 3%.
So 3%.
This reminds me actually. This is a good point. It's a little bit of a rabbit hole, but hear me out here because this idea of like incentives. And where incentives lie for things when you look at like the macroeconomics. So I was listening to this, I think it was on the All In podcast recently. They're talking about, so you have a really good, say size, like the size of your fund means you will operate at a lower profitability, right? So the bigger you are, the harder it is. I put this into context in a real estate business or for like Mike and I in a lending business, right? The bigger our debt fund is, or say you go to a big syndication like Brandon Turner's, $1 billion syndication or however big his was, like, naturally, because the numbers are bigger, it's just too much. You can't manage it as well. A bigger company is hard to manage, hundreds of employees, all that. Where a smaller company, say $100 million fund comes in and they can make 19% margins, this $1 billion fund makes half of that. Well, the challenge is, especially when it comes in like the private equity acquisitions, is a company will come in and say, hey, we're going to give you $20 million for 5% of your company. You're going to be valued at this amount. And this big company comes in and says, well, we need to give you 250 to make this worth it. So now we're going to basically say your company is worth more. We're going to give you 250 million at double the valuation, half the return, because the $1 billion fund is giving their investors, say 5% return. The $100 million fund is giving their investors a 10% return. Naturally, we would want to invest in that $100 million fund, but there's a lot more people investing in the $1 billion fund. So they're basically falsely inflating, because through acquisition, falsely inflating the values of a lot of these private companies or these assets. We'll just say assets in general, because they have so much wealth concentrated. It's like the Warren Buffett issue. Like Warren Buffett says, like, and this is why I think he was lauded for his discipline, is he's like, I can't just go and invest in random companies because I need to deploy $100 billion at a time, or however big his minimum deployment was, right? And so these big funds, what they do is they come in and you see these private tech companies, the founders are going to make double going with the big, poorly managed fund. Well, if they go with the smaller private equity fund who would actually help them be a better company and would return way more value to their investors, the incentives aren't there. They're like, dude, I'm going to make double the money going with the big guys. So they go with the big guys. All the investors make half the returns that they should. And the big guys are incentivized more, because who gives a shit if you're getting a 1% management fee on $1 billion? That's way better than 1% management fee on $100 million. So they can take half of the returns anyways. They don't really give a shit because the size is where they're getting all of their money from, right? The size of the fund.
The bigger ones, like, they're also worried about competition. So if they're like, you actually have a chance to compete with us, how about we just buy you? And like, we'll overpay for that because we just want you out of the marketplace.
Right. Yeah. But again, the investors themselves are actually making way less returns because the fund manager is making double what the guy who's getting good returns. A really well managed fund. Yeah. It's just not. I don't know. It's an interesting conversation when you talk about like how like we're talking about SpaceX IPO and all these like private companies getting bought up by private equity and why they're doing that at these high multiples. And as the investors in these funds, you're just kind of getting punished with really shitty returns because the manager's making a shit ton more money on a larger fund.
Man, I went away for 3 days. You guys are fucking economics nerds now. But Dan took advantage just as right of everything. You got a PhD while I was gone.
Dan and I talked an hour a day every day.
Yeah, we did while you were gone.
I can tell. It's like, I think you guys linked up your Neuralinks or whatever you did.
Yeah, I have. Yeah, did you get yours turned on, Bill?
Yeah, that's why Dan's bald.
Yeah, exactly. I lost my hair. But anyways, I'll just leave that at what it is. I think the good conversation is around incentives. And we talk about this with employees. We talk about this with like investors out there, like where incentives lie. It's just wherever the incentives are is where things go. I've seen it so many times again, so many times.
I think that's a great lesson to wrap up here is before you make any investment or you give anyone your money, just figure out what the incentives are for the people that are involved, how they're getting paid, and does it actually make sense for whatever that investment is to perform or not. And if they have no incentive for it to actually perform, then you probably shouldn't do it. So,
agreed.
Cool. All right. Thanks, guys. Well, go and re-listen to that if you need to, because goddamn, they throw a lot of numbers, a lot of like smart stuff around, way beyond me. But you guys are well read these days, so good for you. But thanks for listening, everybody, and we'll talk to you guys next week.
See ya.
This episode is sponsored by Sir Lancelot LLC, also known as SLA Capital, which, if you didn't know, is Dan and I's private lending company. So yes, we are sponsoring our own show, but what you going to do about it? It is our private lending company that offers hard money and DSCR loans to real estate investors of all types. So you can be a new investor, an experienced investor. You can be buying flips. You can be buying rentals, whatever. We can do everything. And not only that, but the rates that we offer are just as competitive, if not cheaper, than pretty much every other company out there. So whatever big company you've been working with, bring us their term sheets and I guarantee you that we can probably beat it. We have the same connections they do. We just don't have all the overhead and middlemen. So if you want to come and check us out, go to slacapital.com/keys and I will know that you came from the show. And by seeing that you came from here, when you get to closing, you will save $500 on your first loan with us. So slacapital.com/keys, we would love to fund your next deal. Thanks for listening, everyone. If you want more from us, you can shoot us a follow on Instagram. I am at Mike_invest. Dan is at InvestorMan Dan. And Dylan is at Dylan_does_deals. Shoot us a follow and send us a DM to let us know what you think of the show.